ended up here. I actually was a UWA computer science student back in 1994, I think, and I got kicked out of the university. And they said, please don't ever come back. So when I get to do these sessions, I always like to comment on that and think it's very funny that I'm here actually presenting at UWA. Okay, thanks, Chloe. So what we're going to go through. The main thing I'm going to try and get across today, and please, if you want to interrupt me and ask questions, go for it. If not, we'll have some time for questions at the end. This is also my first day back from a 4-week holiday, so if I'm a little bit slow to answer, I'm still just kind of getting going. But when you're talking about funding, obviously part of that is where can I get money from if I need it, and you will at some point. And then normally when we're talking about funding, then you'll start thinking about things like equity. Sounds like you had a quick session on shareholders agreements, which is kind of how you get the agreement around how the equity in the company might work. So we'll talk a little bit about that. And inevitably you end up talking about valuation. So, you know, what's my company worth? And then also if I'm going to be talking to investors, the kind of things that they might be looking for to try and give you a bit of a head start on giving yourself the best shot of getting funding. So that's the plan for today. So, thanks Dylan. Just a little bit about me. Rather than going through the work stuff first, I just think it's nice to hear a little about the person that's presenting. And I was going to comment, actually, it's cool doing this with Charlie because over many, many years, I used to run a program not dissimilar to this called +8, and Charlie would come out and do a presentation for me every year. So it's kind of nice to be reversing roles this time. So, I don't know if you've seen this before. But anyway, so a little bit about me. First thing is this is my wife, Kylie. So if you come across Purpose Ventures, we co-founded that venture capital fund together. We've worked together actually we've married 30 years next year, and we've been doing our startup we did together and the funding we've done together. So worked together a lot. Most people know she's the brains behind what we do and the smartest person, and so definitely better to try and meet her rather than me. But we love travel actually and food. So this was the trip we just had, and this is Champagne if you've never been to that part of the world. So I just thought, oh, well, that's my little holiday I've had. So there we are in Champagne. Despite being married 30 years, we were never able to have kids. So that's actually meant we've been able to put our time into lots of other philanthropic business type stuff, but it also means we have 2 fur children who get loved like kids way more than they should. So this is Maximus and Winston, who we call Maxie and Winnie. And my little hobby, the thing I do when I'm not working and doing this is golf's one of my main things among the travel and food. So a little bit about me from a personal perspective. And then next slide will be the work stuff, which is maybe more relevant. So by background, I won't bore you with my CV, but a few things that are interesting. First one was I worked around the world and came back to Perth over 20 years ago, and as part of that had a startup company called GreenSense. UWA are actually a customer of ours, and we did real-time energy and water monitoring for commercial and industrial buildings. And so I ran that company for 7 years, and then we were acquired by an ASX listed business called Power. And 18 months after that, they were acquired by Shell. It was a really good outcome for our shareholders and our staff. All our staff had options in the company. I had 2 co-founders. Everyone did really, really well out of that. And that sale happened over 10 years ago. And once that occurred, I kind of realised that the thing I was most passionate about was entrepreneurship and helping founders kind of do what we did. And so a bunch of these things, which I won't bore you with all the details, but was my attempt to think about how we build the startup ecosystem in Western Australia. There has been and still is a huge funding gap here relative to other cities in the world. So I was able to take some of the money that I'd made and start investing that, and that went quite well, and then set up an investment group, and that went quite well. And then the RAC asked me to help them set up their venture fund called Better Labs. So I set that up. And so what it's meant, and I'll talk about what I'm doing in a moment, I think the thing that's relevant for you today is 2 things. One is the GreenSense story. I've been a founder. I've literally, everyone that I heard speak this morning, you're like pretty much at the start of your journey, and you've got this problem that you're working on, and you've got your first website, or maybe a few of you've got your first customers, which is great. I've literally sat in your shoes going, this is the moment we're dreaming, this is the company we want to build, this is the team, thinking about how we're going to fund it, all that kind of stuff. So literally done that journey. And so I kind of understand a little bit of where you are at the moment. Like Charlie as well, that's great. We've got an EIR that's been someone that's built a business and sold that. And the other thing is that probably more, I think, than anyone in Western Australia, I've raised the most amount of money that's gone into the sector over that period of time. So these are just some of the examples, but it's well north of $100 million that I've raised and tried to invest in WA companies. And so I think I've invested now closing in on 50 companies. And so again, just in terms of what I'm going to try and share today is all the things that go well and don't go well when you've taken money, and do that from both the founder and investor perspective. So these days, the two things I'd pretty much spend most of my time doing, one's Purpose Ventures, which is the fund. So we a $55 million fund. I'll tell you a bit about that later. The good news for you is that at least 70% of that funding is to go into WA founded or operated companies. We're always and still are looking for companies to invest in. We've just closed our 13th investment. The sadder news is we're starting to get to the end of Fund 1, so we'll probably only invest in maybe 15, 16 companies. So I imagine that fund will be fully deployed by the end of this year. But the good news is we're already backed to do a second fund, and so hopefully towards the back end of the year, that's something we can talk about. So it won't be the end of the journey. The other thing's the Malka Foundation. So have you heard about Malka? A little bit, yep. So Malka is a very high net worth family where the patriarch is a guy called Malcolm Steinberg. Among other things, what you'll know is he was the founder of Time Zone. And he's got a family foundation which is called Malka, and part of that foundation is, well, the bulk of it is to support all the programs around Perth that are doing entrepreneurial training like this. And so we fund that, and I chair that organisation. So over the last 6 years, we've actually put $30 million into the WA startup ecosystem, and venture is one of the programs that we support. So it's very cool for me to be here with both my Purpose Ventures hat on and Malka hat, because funding the team and what you do, it's very cool to see the output of that by meeting you and all the companies that you're building. So hopefully that gives you a sense of, I do know a little bit about what we're trying to talk about today. Okay, let's get into it. Oh yeah. Are you happy doing it? I don't mind doing it. Yeah, let's go. Okay, so if there's one, when we're talking about money, there's one tip. The only tip I'd give you to remember if you can is not all money is good money. And remember, interrupt me if you want to, otherwise I'll try and go for about an hour-ish, maybe a bit less if we can, and then you can ask questions. So what I mean by that is at some point, if you're scaling a business, it's highly likely you're going to get someone to put money into your business. And there's lots of talk about, especially in a place like Perth, is there enough money? Where do I get that money from? My view is there is always enough money for the right team, building the right company, solving the right problem at the right time. And bizarrely, Perth is actually one of the wealthiest cities in the world. You may or may not be aware, but we have the highest number of self-made millionaires per capita in the world, or we certainly used to, but we would be up there. So the money here is just about how do you access that and find that. And so what that means is you should have choices of funding. And so this one tip is don't just take the first check that is written or offered to you, because all money does come with some kind of attachment or agenda or other plan. And you need to make sure that you're aligned to that, because unfortunately, a lot of the companies I've seen over the years I've been doing this will take an investor really early on, and by virtue of who that company or that person is, or the way they put the money into your business relative to the terms or the rights that they have, means that it actually makes it harder to raise money down the track. So, this funding journey can take you on a pathway where even though you might be building the best business, it's the funding decision that can actually make it difficult to build the company. So hopefully today we're going to go through some of the things you need to think about so that you take the right form of funding. And your job, certainly in the early years of your business, as the CEO founder, is to think about how, commercialization is about funding the business, right? Whether that's through customer revenue or other forms of funding. The real key job to me is, as the CEO, is build the vision of the company, build the team that's going to get there, and make sure you've got the money to make it happen. They're kind of the main things you need to think about. So it's a pretty important topic. Okay, so question for you. Why do we need funding? Kind of giving you some clues, but what's the reason? Sorry?
You're not going to do a service to me if I don't pay you, right? Same thing with anybody out there.
Yep. So you got to pay for some services or for some people. Yep. That's one reason.
You need to build your product.
Yep. You got to literally build the product. How do you do that? Might need to pay someone. Sorry, say, oh, yep.
Scale.
Yep, so scaling could be all sorts of things like new product, new market, moving to different place, the money helps you get there. Marketing, someone said, yep. R&D, yep, that's all sort of product development. A lot of where you guys went home. Yeah, so the way I like to think about it, and even though I worked for the RAC, this was never linked to that, but next slide is this idea of the fuel in the fuel tank. What I mean by that is you've got a place to get to, which is your next milestone. Now, for some of you, that might be get to your first customer, others might be get beta product in market, it might be hire your first staff member, some of the things that we've talked about. That might be your next destination. And so the funding that you need is having enough fuel in the fuel tank to get you to that point. And the reason I like the fuel tank analogy, even though it's going to be highly irrelevant in a few years if EVs completely take over the market, but the concept is still the same, is that the obvious thing is you don't want to run out of money, right? So you don't want to run out of fuel, you want enough fuel in the fuel tank to get you to that next destination. But the other thing that I like about that analogy is you also don't want to overfill the tank, like you don't want too much money. I've actually seen a number of companies, and some of which are in WA that I've been involved in, that have managed to raise too much money. And the problem with that is that you then get busy spending that money, hiring a big team. You often do lots of pilots and free things for your customers. And you actually miss out on being lean and having to be really hyper-focused on solving the problems in the business at the time. So not everyone views it the same way. And I would say that today, you could have a different investor in the room today saying things that are very different to me. I'm just going to share my experience. Some people just say you should always be raising and raise as much as you can. My experience is companies that have raised too much, often when they run out of money, they've suddenly got this high cost base. They haven't learned the lessons that they probably should have learned with less money and things. So, there is a limit in terms of what that should look like. Okay, next slide. Thank you. Other reasons about why and when you need funding. This is when you need funding. So I'm going to give you 2 slides on when you need funding. And look, this isn't the same for every organisation, right? You might be a very deep tech business, was it flow bats? Like you guys are probably going to need a lot of money. I would imagine in an R&D phase, your journey is going to look a little bit different. But trying to be generic here as to what the stages you're at, the kind of money you might need to raise, and who you might get that from. Just 1 slide summary. By the way, I think the team has these slides, so I'm happy that they get sent around. You don't need to take photos. You can just grab them if you need. But the point is, you've got your idea, you're starting to build the first version. Sounds like a lot of the in the room today are like that. You've got your first product in markets and that's starting to work. So now we're starting to scale that up a little bit. And now we've actually got a profitable product, or we understand how to sell. So now we start scaling and then we kind of get to our exit if that's part of your plan. And you can see this pink line overlay. The problem in the words that you'll often hear is this concept of the valley of death. And that is that in these early stages, you're very rarely making money. And so at the point you're making money in scaling, there's a lot of, there's a lot of people that will want to back you, right? That's an easier stage when you're much later to go, well, I understand the unit economics of your business and it's working, I'm happy to give you money. The challenge for you as a founder is in all these early stages when you're not making money and you're doing your R&D, you still need the money as we've discussed, but where might you actually get that from? And so as a very high, like very generic kind of idea, these early days might actually be your friends or your family or even your own savings is the money that goes in, because you don't really have a lot to show. So you've got to work that on the relationship. As you get going a little bit, there's these early type of investors called angel investors that might want to be able to put some smaller checks in but can support you. And then as you start scaling, you get into the more institutional money and venture capital, and that's where that kind of comes from. So that's sort of how that journey might look like. Now in the funding journey, you'll often also hear these terms like your pre-seed round or your seed round or your Series A. If you follow any of the sort of tech journeys, you might hear about this. And in fact, some of the companies, I think Anthropic I think they're doing their Series G, I think it is at the moment. So that's how many rounds they've done before they sort of get to listing and things. And so again, roughly speaking, these are what I would say are Perth, West Australian kind of numbers that I see. If you're in that pre-seed round, you're in that stage of, I'm trying to figure out whether this is even a problem worth solving and that I've got a business for. And so, if you're raising money, you might need 50 grand or 100 grand to get going or to build the product and things that we talked about. And it probably means the valuation of the business is going to be, less than $1 million. You haven't really built value yet. And then you get to your seed round. To me, this is going, you've actually built something now and you're just trying to check whether there's that market fit and whether you've got customers. Again, very early stage in the business. And most of the seed rounds I see in Western Australia are kind of $500 to $1 million, or maybe like less than $1 million. And again, the valuation's kind of 2 to 5 mil. You've kind of created value at that point. You've probably got an MVP or a product. You've got a bit of a team. And so there's some value that you've got. From there, and every series after, you get your series A, B, C, D. Now, I think, for me, the definition of series A is you've now got something that's working. It might be small, but it's repeatable, and you can start building that out. So your series A is now we're going to start putting, marketing or a sales team behind that, and we're going to start building out something that we've now proven. Series A rounds for us, that's sort of 3 mil and upwards, maybe up to 10 mil for a bigger seed round on the East Coast. Again, depends on your type of business. And again, valuations are in these kind of ranges. I'll come to valuation in a minute, because if you do the maths, what you'll realise is that, in my view, what I see is most rounds account for about 15 to 20% of the valuation. So remember that, we'll come back to that later. And then Series B onwards, maybe that's sort of north of 20 million usually. Basically, each time you're adding capital on that Series B, C, D and beyond is, to me, the next stage of growth. So that might be that you're adding a new product revenue line. It might be that you're moving from Australia and now we're going to flip up and expand into the US or Singapore or the UK or a bigger market. It's that next kind of stage of growth. And so that's kind of the rough staging. There's no science to it. I don't really care what a round's called. You need money. There's a valuation. Let's kind of get it done. It doesn't really matter what it's called. Now, while we're talking about raising, something capital that I'll often like to just point out is that how long it actually takes. Because as a founder, most of the time I find people underestimate how long it takes to raise the money. So from my view, from the moment you've gone, I'm going to raise money, and you build your pitch deck, it can be about a 6-month period before you see that money in the bank. Now, that's really important to keep in mind if you've already got money that you're spending and you've got team that you've got to pay and things like that. You want to make sure that you're planning around it. Now, it can go quicker. We've done rounds within 4 weeks. But if you think about it, what happens is you build your deck and all the information that you need. You then start reaching out to investors. That just takes a couple of weeks. And by the time they book in a meeting and you go and have that first meeting, and then if they're interested, certainly if you get to the venture capital kind of stage, they're probably going to want to have another meeting, and they maybe want a product demo. And so that's happening over a few weeks. And then they'll go into due diligence, and we'll talk about this a bit later. And you've got to provide information. That takes them a couple of weeks to get through that. And it's only at that point they start saying, okay, now we might think about offering you a term sheet and an offer to invest. Once they've done that, at that point, and this is no offense because now I know there are lawyers in the room, then the lawyers get involved, right? And so you've done your commercial deal, but you've actually got to go through all the documents. Sorry, I forgot your name, Paul.
Sorry?
Paul, yeah. Paul was going through before. I only caught the back end of it. And in the nicest possible way, I have a view that if you give a lawyer a document, the way they determine that they've given you value is they make a change to that document, which means they're going to change whatever you give them, and that's going to come back and your lawyer's going to change that. And this process just goes on. And
our product will make that much better.
Great. Okay, there we go. Good. Speed it up. And again, no one's doing anything wrong. It's just how long does it take to give someone a document, review that, go backwards and forwards. Often that process can take equally as long as it did to do all that. That's just what it takes. So you can see how it can easily be 6 months. So if you're raising money, like even now, for some of you put your hands up, if you haven't started that process and you think you're going to get money in August, September, I'd be like, I think that's highly unlikely. Like, you need to kind of think about that. The other thing, just to touch on real quick, again, just get a copy of the slides for this. It's just a slide that I have which goes through a lot of the major accelerators around the world and what they say should be in your pitch deck. And those big pink dots are the ones that are consistent across all of the programs. I think that's about right. The only one for me that I'm surprised is missing always is this traction and milestone. I know as an investor, I'm always thinking, well, tell me what you've done. Like, have you got revenue? Have you had any customer feedback? Have you got any daily usage in your product? Like, what does that traction look like? That's usually a pretty big thing. So I'm surprised that one's missing.
Derek?
Yeah.
Just what do you want to see on the founders slide, founding team? everyone wants that.
Oh, yeah, okay.
What do you like to see?
Okay, that's a great question. And so I'll answer it this way. So for me as an early stage investor, if you said to me, what's the most important thing? It is the team. Like we often say, 70% of what we're backing is the team. And the reason is, and this is in our case, right? Other instances might be different, but I believe that if you're a founder that cares very, very deeply about a problem, you're now spending your life trying to solve that problem, right? Our whole venture capital name, Purpose Ventures, is geared around that. It's like we're trying to back founders that are chasing their purpose or their life cause. And the reason that's so important is that things will get tough and they won't go to plan. And if there's this deeper thing that you're trying to chase after, you'll just have the resilience and perseverance to keep going even when things get tough. And so we're looking for that. Now, at a very practical level, when it comes to founding teams, some investors will say they're looking for a mix of certain skills, which, you know, we're like this. So we're looking for the industry knowledge, we're looking for commercial knowledge, and we're looking for the technology knowledge. And so these three kind of things. Now, sometimes, but very rarely, they might exist in a single sole founder, but usually you're going to need multiple people in the team. And if you haven't got them in the founding team and you're actually raising money for that, we kind of want to understand what the plan is as to why you're doing that. So industry is, you're not going in blind. There's always industry knowledge. So who is it that's worked in that industry before? Technical knowledge is you're building usually some kind of innovation. So if that's software, who's the person that's got the software skills? If it's building batteries, who's got the battery skills? And then the commercial skills, at the end of the day, to build a business, and this is where I often see things, to be honest, fall over, is the ability to sell, the ability to negotiate, the ability to do contracts. So again, who's got the experience in the team that's got? I think if you've been able to demonstrate, to answer your question, those three things, then that's a really good thing. In Australia, and certainly in Western Australia, we're not necessarily looking for founders that have built a company and exited, because it hasn't really happened. But if you're in the US, for example, you probably find, unless you've tried to build a company and failed, you're unlikely to get backed. That's part of the experience that they're actually looking for. Okay, so we're going to talk about types of funding, and this is going to be very interactive, which is why I have the chocolates. I normally bring Freddos, and then Kylie bought the Smarties, and she said, oh, you could say that's for the smart people, but I said, that's her joke, not my joke, so literally. Anyway, so the types of funding is what we're going to do. All funding that you get in your business is either dilutive or non-dilutive. And what I mean by that is you're either giving away equity in the business or you're not. And I've just added this for the first time on this other side, because often when I just make that statement, people think that it's bad to give away equity. And it's sometimes the case, but usually not if you're trying to build a large scalable business. And what we're trying to say here is that if you own this part of the business, this part of the pie, it doesn't really matter if it's 80% if it's a small pie. Like you can give away equity and actually have a smaller part of a much larger pie, and that's still a really good outcome for you if you're driven by that kind of thing. Just as I mentioned, size of the pie, for everyone in the room, I've noticed, I'd say over the last few years, as I've been doing more and more sessions like this, there's lots and lots of great ideas. But I would say one of the challenges we have in the startup industry in Western Australia is the larger ambition that we need to build an industry. So again, can't comment on any individual business, but we really need people that are prepared to build and scale and build that company globally, impact globally, particularly if you're of the view that we can't continue to rely on the mining sector, for example. We need to diversify our economy. But in order to do that, we need to build billion-dollar companies. And so I just want to, you've got to do your journey. You've got to figure out what your company is about and whether it's about your lifestyle or building something big. But I definitely want to encourage you to think about how big is the pie that you might be able to build, and funding is, of course, part of that journey. Okay, so what we're going to do is look at the types of funding, some of the types that are available, but this is my bad humour. I'm going to put up a picture, and then you've got to guess what the type of funding is. And I've already actually told you a few of them as we've gone through this morning, so this will also show me who's been listening. And if you get it right, you get Smarties or Freddo. Okay, it's about that time of the day. Okay, good. So And then I'm going to do this quick because there's quite a few of them. And then I'm going to give you real quick pros and cons of those types of funding. Okay? All right, so here's the first one. Has anyone seen me do this before? I do this a lot. If you've played the game, you're not allowed to answer. Okay, so any idea what type of funding this is? Wow. It is the Shire. Someone said the Shire. Yeah, at least you answered first, so you can have Smarties for answering. There you go. But it's not the answer. Oh, not up to that yet. Well, no, you've got to guess what the funding source is, and then we can decide whether it's... No. Keep that up your sleeve, though. Council, what is this? Maybe it is a Hobbit, and what is it for the Hobbit? It's a house, and so what does that look like? What might that be? What kind of the funding? Kind of loan, debt, sort of, okay, we're kind of getting there.
Fund a building database for it.
Yeah. Self-funded, there we go. Let me explain. So, very good, you get a Freddo for that. So self-funded, so this is your own money, right? Like most people in Australia, and I appreciate housing is an issue and there's a lot of young people in the room, but a lot of people, our main asset or our main wealth is our home. And so, this is your personal capital. I'm not saying put your home on the line, by the way, although you might want to get some of the equity out of your home to help. That's definitely a possibility. So this funding source is your personal money. Now, there is nothing, if I'm an investor and I'm going to invest in your business, there is nothing that sends a better signal to me than you going, I've put some of my own money into that. And in fact, if you haven't, and you're trying to sit there and tell me about this billion-dollar company, but you're not prepared to risk your capital, it's probably unlikely I'm going to risk my capital. Now, there is an element of this which is a little bit about age, which I don't mean to be ageist, but there's a lot of young people in the room. It's like if your life savings is $10,000 and you put the whole lot in, then I'm like, that's amazing that you've been able to put everything you own into that business. If you're maybe 50 and you're only putting in 10 grand, I'm kind of like, I don't think that's enough relative to the wealth that you should have made. And if you haven't made enough to do more than that, then I'm not sure I want to risk my money with you either. Like you've got to sort of demonstrate that. Does that make sense? I know it's a bit of an awkward thing to say. So, hold on, I just gave the answer there. Dilutive or non-dilutive? Who saw that? Free chocolates. No, what was that? Non-dilutive, yeah. Okay, so it's your money. You just put that into the business. You own the equity. So this is personal capital. So it shows your commitment to the business, and I just think when you then bring in external capital, it creates that kind of alignment. Okay, next one. Yeah, triple Fs. Tell us what that is.
Friends, family, and fools.
Friends. All right. Well, look out. Health, safety. Yeah, good. Friends, family, and fools. Okay, so this is people that know you, and they think you're going to be the next Jeff Bezos or Mark Zuckerberg, and you've created this company. They do not want to miss out on being part of that journey, and so they might be prepared to give you some money. The good thing for you about this is that they will probably know nothing about your business, but there'll be some relationship that says, hey, I want to back you. I want to give you a shot. So is that going to be dilutive or non-dilutive? Non-dilutive.
I'm going to help with the discussion.
Oh, thank you. All right.
Where to go.
Yeah, non-dilutive. Who said that first? Someone here. Yeah, okay. Yeah, and pretty much friends and family, I mean, they might give it to you as a loan, but mostly it's going to be for some kind of equity in the company. So friends, family, and fools. So they're going to back you because they know you and they trust you and they want to be a part of what you're doing. The thing to remember, unless they're in your industry, they're probably not going to add any value to the business other than the money that they give you. And the thing I would just say is you're a startup, which means as far as investments go, you are the highest risk asset class that anyone can invest in all the asset classes there are. So you want to be careful who you're asking for that money. And if you're asking, don't ask grandma for all of her superannuation to go into your startup. You're a high risk investment. So if you can, if someone that you know is going to give you money, try and temper that with how much is like an amount they could lose if they were to lose that money. The other thing I just say on this funding source is, which is something really important, is to think about how you think about your friendships and business. So we have this saying, do you make friends out of business or business out of friends? You want to be careful if you take money into your company. There is a high chance, most 9 in 10 small businesses fail, right? So not that I want anyone in this room to fail, but there is a higher chance that you'll lose that money. So you want to make sure that for me, I wouldn't want to put my friendships and relationships on the line for that. In our venture fund, we have taken money from people that we know and are close to, but we've done that relative to their level of wealth. And we've been very clear that we're a high risk asset class. So just something to think about if you're going to take money from friends and family. Okay, next one. Yep. Yes. Oh, there we go. First up. Okay, so bootstrapping. So if you haven't heard of that, dilutive or non-dilutive? Maybe I should explain what it is. Non. Okay, we've got chocolates down the front. So bootstrapping, if you haven't heard that term, is that you build, and I suspect, sorry, Adidas, Mr. Adidas. What was I saying? Bootstrapping. So what it means is while you're building your company, you're just doing other kind of work to fund yourself until you get to the point of needing money. So it could be, I appreciate a lot of people here are probably studying, but it might be you've got a part-time job or even a full-time job and you're doing the work on the business at night and on the weekends while you get going. Maybe over time you go back down to a couple of days a week and then you keep building the business like that. And you keep doing that until there's a point where you can jump in full-time. Now, a couple of things I'd mention. My company, GreenSense, this is how we did it. We were 3 guys that had tech skills. The way we did it, actually, the other 2 guys for 4 days a week worked in IT consulting jobs. And I worked full-time in the business and they did 1 day. And we did that for the first 12 months. And the money they made went in for us to kind of share and live off. I think it's a very good way to kind of self-fund the business. And all those stages we talked about before where you're kind of de-risking it for investor, getting your first customer, getting the first product in market, you can kind of do that before you bring other people into the business. And what it can mean is that when you go to market, you've actually de-risked it a lot, which means you've probably got a chance of attracting investors a bit faster. The caution I'd give you if you do this is it can get pretty easy to live in both worlds and never actually make the jump into the startup to give it everything that it needs to get going. Like we had contracts with BHP and Woodside and they came up for renewal. And I think there was like 400 grand between the 2 contracts. Yeah, it's a lot of money back then, is now. And we had to decide to say no to the contracts and go full-time in the business or keep going. And so you get this inflection point and you don't want to miss that. And certainly for me as an investor, whilst I like the idea that you would have bootstrapped the business to de-risk it, if you're not full-time in your company and only doing that one thing, I won't give you my money, because until you've got the conviction to jump in and go all in, then I don't think you're ready to take investment and start scaling. And we won't be the catalyst for you to jump in full-time. You've got to have made that decision yourself, because remember, founders and your belief in the business is really important. Questions? Yeah, I think you were first.
I was just going to ask, how did you manage that equity between you working full-time and the other founders?
Great question. We'll talk about equity in a moment, but the way we did it is we were all a third. And the way we differentiated was on the salaries that we could pay. In the end, when we got going, I actually did 3 days a week. My wife and I used to pastor a church as well, so I could only ever do 3 days in the business. One of the other guys had young kids, he did 4 days, and the other guy did 5. So we differentiated the salary pro rata based on the time. That's how we did it. There's no right or wrong, it's just negotiation, as Paul was saying before, I think, as to how you figure that equity out. But I'll give you some tips on that a bit later on. Yeah.
So, as students, we work part-time, assuming. It comes to a stage where we're not able to put in our own money anymore.
Yeah.
It risks, like, we are on the streets. It comes to that.
Don't do that.
Probably at that stage, you kind of go into funding all of that, right? So, what does it say when this is like a value of debt aspect, that part? What message does it send it to the VCs or like people investing in that? This is a loss-making business. How do you deal with it?
So is your question about the loss-making business or about being part-time or about being a uni student? What's the question?
Loss-making business.
Loss-making, okay. Loss-making, no problem. Every business we've funded, every business is loss-making. So the point of venture capital is to fund that gap. Now if we talk VC, venture capital, every investor will have a view on how long you should be not profitable for, and therefore how long they're prepared to fund you. So we've got some companies, I'd say, that are, let's say a traditional SaaS like software company, they need a couple of years to build the product and get their first the first customers, but I'd expect by about year 3 or 4, they should be break even and being able to make money, unless they're going to jump into a new geographic market, in which case you start that whole journey again. So we'd be prepared to fund that company loss making for 2 or 3 years. We've got another company which someone mentioned before, which is the picture at the start, Andromeda, which is a robotics company. They'll be probably a loss making until we sell the business, because it's such a deep R&D kind of business. But we're building to actually create a whole new category of product and kind of social impact. That just takes a lot of money to do that. So the thing for you to think about is, when you build your model, today's not really about models, you'll be loss making for a few years. Certainly from a venture capital perspective, we only really want to fund 12 to 18 months at a time. And the reason is, my model works on, if I invest in you and you've got a valuation, I kind of need in about 12 or 18 months you to go and get a high valuation, so I can tell my investors that we've done a great job. That's kind of the reason for it. No one probably tells you it like that, but that's the way it works. And so if you think about what I was saying earlier on, remember how long did I say it could take to raise capital? Could be 6 months, right? So normally what we would do is fund your loss for 12 to 18 months, plus the 6 months that we think it's going to take you to raise money. So we'll still fund you through that. So normally what would happen is you try and make as much progress with our money as you can over a year. You then start the next capital raise. Ideally it takes 6 months, so by 18 months you've got more money to go again. And if things don't quite go to plan, you've still got a little bit up your sleeve. That's kind of, for us to put, the moment we put money in a company, there's no point us seeing you fall over because you've run out of money. Like, we've kind of backed you. As long as you're doing most of what you said you're going to do, we'll keep backing you. And to be honest, we've got 13 companies. There's one in the 13 that have massively under-delivered, and we probably will not back them again. And that makes that really challenging for them, but that's kind of our model, right? All other 12, they're all lost on it all, but most of them are loss making, and most of them are behind the plan they gave us, but they've been doing their best. If they got stuck, we would give them money to keep going. Yep. And I think that's really important. I remember early on I said not all money is good money. Obviously I think we're good investors, but you're looking for alignment with people that have got not just one check, but the ability to keep going with you and be like an investment partner, and also have got investor networks. So even if I can't, like if my fund's about to run out of money, I want to be able to introduce you to other investors that can put money in and things like that. So, yep. Okay. All right, next one.
Real quick. So you're potentially funding...
You don't get a Smartie for that, but go on, yep. Go on.
That is real quick. He's probably just taking one of my jellies. When you're funding these people for up to 18 to 24 months, what are they paying you back, and when are they paying you back, if they're paying?
So 24 months would be unusual. We're normally trying to go, hey, how much money do you need for 12 months? Remember, fuel in the tank, how much money is the next milestone that you can reach in a year? They need to go and raise money again. Companies we're backing are like on a high growth trajectory, and that's just the way it works. My fund is a 10-year fund life. So no matter what, and I'm 3 years into that. So when we invest, it's the founders that take our money are very clear that within 7 years now, we have to get our money back. Now that doesn't mean the whole company has to sell. There's lots of ways that can occur, but that's the way we have to do it, because we have a regulatory requirement in Australia that our fund has to get out within 10 years. But because we're 3 years in, we've only got 7 left. But if we do our next fund, we're 10 years again. Now, so what we get back is return of our money plus whatever gets made along the way. And that exit can be a number of things, right? That could be that the company actually sells and the founders and us and everybody, all the investors get their money back, but it can also be just a partial sale of our money, so of our holding. It's not a big market in Australia, but it's called a secondary market. So once companies start getting to a certain size, people might come along and want to buy my stake out and keep going with the company. So the whole company doesn't have to exit. So I assume everyone in the room knows Canva. And you might have seen that about a year or so ago, Canva had an exit event. And so a lot of the investors got the money back. That was not because Canva wanted to start selling their equity. It was because the venture funds like Blackbird that had been in Canva had been there for 10 years and they had to exit. So it was driven by the venture capital groups having under regulatory requirements to sell their equity. And they sold some and kept some, and then maybe Canada will do their IPO and then everyone will get the money back that way. So that's the way it happens. Roughly speaking, maybe just because we're talking about this, bit off track, but it'll help. When, your question of me getting my money back, the way venture capital works, and just actually let me caveat this, we're going through lots of funding types. So your question and my answer is about one funding type, which is venture capital, right? There's lots of others we're going to look at. But in venture capital, it works on the premise that probably only 1 in 10 of the companies we back are going to do really well. And that means that one company that does well has to make up for all the returns I've promised my investors, as well as on the basis that I lose money in 9 in 10 companies. So whenever we look to make an investment, we're trying to say to ourselves, do we believe that one company could return the whole fund plus all the losses? And roughly speaking, when you think about a 10-year fund life, the lowest end of that I need to give to my investors is 3 times the money. But in order to get 3 times the money, that means the one company that's going to return that plus everything needs to be generating about a 50 times exit on my money. So we're a little bit different because we're quite hands-on with the company. So if we invest in your business and you convince me that you're worth 10 million, we roughly work on a 10x number. If I invest in you at 10 million, do I believe I can help you get, and you have the ability to 10 times that to 100 million? That's kind of roughly how we're thinking about it. And if that works, we get our money back. Plus what we need, yep.
I'm just wanting to attach onto that. So say if the business is valued at 1 million and you are to invest 1 million in the business or however much you want, like what is the usual percentage of stake that venture capitals would like to take?
Yeah, so what I'm going to do is park that because we're going to answer it because I want to go, because we're talking specifically about venture capital at the moment, the questions, and that's only one funding source of all the types, right? And so we can answer all the questions about that at the end, but I just want to make sure we see all the funding types and then we can answer that, but I would definitely cover it, and if I forget, remind me. What's this funding type called? Accelerators, but you've already had some. You can share with your table, but yes, very good. People normally take a while to get that, but you were looking at it for a long time. Okay, accelerators. So it's kind of what you're doing at the moment. So accelerators, is it dilutive or non-dilutive? Yeah, it depends, right? So whoever answered that first, who answered that first? Paul took it. Yep, good. Like it. Yep, be bold. You got to. Yeah. So in this context, I normally say it's dilutive because a lot of, I know it hasn't been for you guys, but a lot of the time when you go into an accelerator, they're giving you what's called a safe note. So they're giving you money, and that safe note will convert to equity at some point. So an accelerator is any kind of program like this that you come to maybe 3 months or 6 months and helps you build your business. The great thing about accelerators is you get a lot more than just the money, and it's different levels. So the highest paying accelerator in Perth is called +8. And I think they're up to $1 million pool or something, or maybe, I'm not sure, Charlie, you might know, $500,000 pool or something. I think.
About 750, 800 this year, yeah.
Yeah, okay.
Of investable money.
Investable money.
1,000 from the government to run the actual program.
Great, okay. So yeah, $1 million all up. So if you get into that program and get the funding, you probably could get a couple $100,000 check. The other big one really is StartMate, which is an East Coast program, and they still work on the basis of $150,000 checks. And what they do is they give you that on what's called a safe note. That stands for Simple Agreement for Future Equity. It's a very, very simple agreement, unlike what Paul was talking about. And it just says, we're going to give you the money now. We're not going to worry about talking about all the terms or the valuation. It's just going to give you the money. And all it says is when you eventually get a priced round, we're going to convert, usually with some discount to that because we've come in early, and that discount can range, it's normally like 20 or 30% or something like that. And so that's the way they kind of do their deal.
We don't take equity here.
Yeah.
Just so you know. So we are non-dilutive.
Non-dilutive. Yeah, a grant, yep. The thing that's best about accelerators in my view is even if you've got a couple $100,000, is all the stuff you're experiencing. You know, you're getting to meet a group of people that are probably building a different kind of business, but going through the same kind of problem, that peer network. And often I've seen these programs, you know, create friends for life sometimes out of what you're going through. You get, you know, masterclasses like this where you get people coming along and sharing their expertise. You get a network, like normally, like I'll say to you, if there's any question you wanted to ask me that we didn't get to today, you can just ping me a note on LinkedIn and I'll do my best either myself or my team to answer it. I only offer that because of the connection we have with Chloe and the venture team. I don't make that broadly available. So you kind of get this network effect of being a part of these things. So, and there's other programs, but because they're other universities, I'm not going to mention them.
Just on the safe note, how does that, I hear it's for future equity, but why not just equity at that time?
If you do equity at that time, then you have to negotiate what the valuation is to determine how much equity is given. And then the moment you're doing that, you're putting in an agreement which talks about all the shareholder terms. So again, because I caught Paul's session, he was talking about things like tag along, drag along rights and all sorts of things. So the idea is, because that can take a lot of time to negotiate, they're just saying, we just want to get you the money so you can actually start using that money to build the company. And the only thing they're looking for in return is that when you do get a valuation, that they get a 20% discount on that valuation because they came in early. And there normally be one caveat there, because at that point, when the safe note converts into equity, they will become a shareholder. There's usually a line that says they still have to approve to whatever terms go into your shareholders agreement. So yeah. The accelerator, if you, maybe just on that, if you take a safe note from an accelerator program, it is never in their interest to not let you get your price round away. So they never will really get in the way of the terms or the valuation, because they're trying to do that en masse and you don't have to worry about it. Where I'd caution you is, for some reason, I don't think this is right, but lots of companies now will just try and raise a round on a safe note where they're not attached to an accelerator program. We won't do that as a venture capital fund, because really what the founder's doing is saying, I don't really want to work out the valuation with you. I need to do a bit more building. Can I have some of your money to help me to do that? As where from my point of view, I'm like, well, the company is worth something at the moment. And actually one of the hardest conversations we're going to have is valuation. And because we're going to work together for a long time, I'd rather have that difficult conversation right now and see if we can negotiate well and create a win-win for you and for us. And if we can't, I don't want to invest. So we would sort of force a price round at that point. Does that make sense? Yeah. Okay, next one. Angel, you already got chocolates, but yes, angels, very good. This is the movie Angels and Demons, in case people are wondering. Dilutive, non-dilutive. Keep giving it away. Yep, great, dilutive. Yep, so angel investors. What we mean when we say angel investors, these are high net worth individuals that can give you anything from $5,000. Actually, the investor in my company was they call a super angel. He gave us $1 million. Is very high net worth. Green sense I'm talking about. So anyone that can give you that amount of money, they can be people that might have had an exit and they're in the tech ecosystem and have that kind of interest. But these are kind of like the wealthy people in your world. Think like doctors, lawyers, vets, people that have, on high incomes. They're probably able to, maybe invest $10,000, $20,000 in your business. That can be an angel investor as well. The good thing about angel investors is a couple of points. One is they'll often come in much earlier, they will come in much earlier than a venture capital fund. So when you need that first 100,000, 200,000, 300,000, we just would very rarely invest that low. But angel investors, you might be able to put a few together and then you can get that round away. They often will invest in your business because they've got experience in your industry. So they can often provide more value than just the money. And you may find they're often business people and they're happy to catch up with you once a month or once every couple of months just to check in on some of the things and have a chat. So I think angel investors are really good and important part of the startup ecosystem. There's two ways to find them. Either they're people in your network that have got the types of jobs I mentioned and you might find them that way, or they do hang out in different sort of groups. So in Perth, there's a group called Perth Angels. Over in Melbourne, there's a group called Med Angels, specifically for medical investments. There's another group called Innovation Bay, which is a network of angel investors. And they kind of just run events and you can pitch to. Normally either Southwest Angels, actually, here in WA. Normally you can just put an application online and if they like you, they'll get you along to one of the pitch events and go from there. There's also groups starting to form around the country, but in Perth I mentioned a few that are called syndicates. So what they'll do is go, we're going to pull together maybe anywhere from 2, 3 or 4 investors up to 20 or 30, and they might all only be able to write $5,000 or $10,000 checks, but collectively that syndicate can write you a single $100,000 or $200,000 check. And then they'll actually facilitate that whole process for you. So Venture X is a female syndicate, like female founder syndicate. West Tech is one of the big conferences you might know. There's a group around there. Curtin University has one. I know Chloe's got thoughts and plans about how we put some stuff around UWA companies as well. So that way they can kind of come along and see, the programs and back them. Yeah.
Let's say if there's a single angel investor, could they have a big say in product development of decision making?
So I think if you go back to that first point I made, not all money is good money. So you've got to work out whether you think that's a good thing or not. My view is, if you ever had an investor that thought they should be telling you how to run the company, that's not a good thing. So in our case, we will have rights in your business to help you make decisions. But if you get to know us, you'll understand that we're trying to do that from the perspective of help you look around corners to see things you've not seen before and kind of get you the value of our experience. As where some investors will feel they know better and they want to determine that, and they can even contract that. So yeah, you just got to figure out whether that's right for your business or not.
Next question.
Yeah.
Derek, in your experience, you talked about NDAs a little bit before as well.
Mm-hmm.
When people are going pitching to these sort of events and talking to these people, what's the general industry standard in relation to NDAs?
NDAs? So in our case, we will not sign an NDA. So if someone approached us and said, we've got this amazing IP, blah, 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 sign an NDA and we'll talk to you, we'll just say no. The reason for that is not to be difficult. NDAs have their place. I'm not trying to undermine that. But if you think about my business, I spend every week in, week out looking at companies. And so there's two reasons we don't do it. Number one is if I signed an NDA with one company and we didn't necessarily invest, or there's something there, I can tie myself in knots for all the other companies that I might see, because we just see like literally thousands every year. The other reason is, in my view, there has to be an element of trust and relationship. And if I don't work on the basis of confidentiality, no one's going to want to do business with me anyway. So if you pitched to me and you had some IP and then someone heard that I told them about that or gave that away, all you've got to do in the market is say, Purpose Ventures is not confidential with information I've shared. I don't have a business, right? So in some ways for us, I think also my view of IP is that in certain industries, like let's say pharmaceutical, they live and breathe on patents and that IP. But I don't think there's a business I heard here today where IP is your defensibility strategy. Because the thing is, like whatever you're building that you think is intellectual property, if you go and get a patent, for example, to protect that and someone copies your idea, what are you going to do? You don't have the money to go after them and you're probably not going to. So it's sort of not the defensibility strategy. For me, your defensibility is build towards something that creates a moat around your business that means no one else can actually do what you do. Maybe that's through trade secret, through software, through the way you do your contracts. Like we've invested in a company recently called On the House. Maybe you've seen it, but the lady puts vending machines in public places that give away free period products, and it's funded by advertisers that go on those screens. Business is going absolutely gangbusters. But really, at the end of the day, the machine comes from China and the advertising is just a commercial deal. What we like, the defensibility, is two-layered. One is we're getting data, so we're building a data layer that no one else will have. But when we put those machines in, we contract them that they can't put any other machine into that facility for anywhere from 3 to 5 years. Well, that's exclusivity. So it doesn't matter what IP we've got built into the machine, we've commercially created defensibility. So, sorry, very long-winded answer to your question. But right, next one. We're way behind time, that's all right. Grants. That's a bad one, isn't it? That's a bad one. That's Grant Denyer, if you don't know him, and there's two of him. So anyway, are grants dilutive or non-dilutive? Oh, you've had one. There's some mumbling over there, I think. Non-dilutive. There we go.
You dropped the ball. I played it up for you.
Okay. So grants are great because it's someone giving you money, which you can use for often whatever you like, and it's non-dilutive. And those grants, there's a whole bunch around. Charlie definitely and Chloe will know more about where to go. A few I've thought about. So in WA right now, there's Industry Growth Program, Innovation Booster Grant. Industry Growth Program is a federal government program. Is it still running?
No, it's currently shut down.
Right, so forget about that one. Charlie used to be
2 weeks ago.
work on that team. Innovation Booster Grants and Commercialisation Bridge Grants are a WA government. Charlie also helped set that up, so he's your man. The thing I think about these is that even if you don't get the grant, and they can be anywhere from maybe 10 grand, the Industry Growth Program, which we got at GreenSense, used to be up to a few million. Even just writing the application is actually quite helpful, because you have to kind of think about the way you're answering those questions, and often it helps you navigate some stuff you might not otherwise thought about. So I think that's good. The other one I've put into this bucket, which is a little bit different, is the R&D tax incentive. Have you got someone that comes and talks to you about that?
We briefed it before the last time, and then we're going to
Yeah, I think it's one of the best funding. When you start spending money, if you qualify, when you do your tax return, which you'll normally be making a loss, any money that you've spent on research and development, the government will give you back 40 cents in the dollar for that. And you can even get loans to advance that as well through different providers around the place. So that's a really good way the federal government supports. Crowdsourcing, yep, okay. Dilutive or non-dilutive? Both, yes, all right. Have you had a chocolate yet?
No, I don't want one anyway.
You don't want one? Oh, yes, good.
Well, you can catch it. Derek, can you catch it?
Maybe, depends what your throat's like. Okay, so crowdfunding, there's two types. One is for product. So this is like Kickstarter. So I've got a product idea. I like crowdfunding for product, but it only suits certain types of businesses, normally those that are selling to a consumer type of market. And so, Kickstarter, Indigo, there's a whole bunch of platforms. The thing I like about that is that before you've even built the product, you can go and test whether there's customers that want to buy it, and you get all these early supporters. They give you the money, and then you can use that money to go and build that product. And so that's non-dilutive. I've been involved in a bunch of Kickstarter campaigns. Probably one of the most successful was one of the RAC Better Labs companies called Plant with Willow, where they put these sensors in plants that sort of talk to you about what their problems. They're now in John Lewis in the UK, they're in Bunnings and a whole stack of stuff. And that started on a Kickstarter campaign where we wanted to test the market. The other type is crowdfunding for equity. So this is where, rather than giving a version of your product, you might raise, let's say, $500,000, maybe up to $3 million, and you run it on a platform. The most known in Australia is called Birchal, and they'll run a campaign for you, and they'll get together lots of retail, like mum and dad investors that might only put in a couple of grand, and then all of that will come together to hopefully raise you a bigger number. I think this works okay for some types of businesses, but I would just caution you going down that pathway on a couple of things. If you need to raise more than once, there is very, very little track record in Australia that anyone that does a crowdsourced funding for equity is able to go on and raise venture capital. There's reasons I won't go into it today, but if you took crowdfunding for equity, we basically look at it as that's your last resort. And so the chance of us then backing you after that is pretty low. It also means you've got to create a certain structure in your company to do that, which isn't conducive to us investing. When I say us, I mean venture capital. So I just be cautious. If you're just doing one campaign, you need $1 million, that's gonna be all you need to get going, then it can be a really good way to do it. This is the best form of funding. Customers. Right, dilutive or non-dilutive? Non-dilutive, okay, so customers. Best kind of funding. At the end of the day, there is nothing better than one customer paying you $1 for the one thing that you've built. And if I'm an investor and you can show to me, here's my paying customer, I get really excited about your business. And we do invest pre-revenue, but it's rare. And the more I do it, the more I think we're just going to wait till you've got customers, unless you're a deep tech kind of business, because it just demonstrates that you've got some kind of fit, some kind of interest. And when you build out your model, there's a whole stack of assumptions in there. And the minute you've got someone that's paid you something, you've de-risked that model a little bit because you can point to actual data and things that have happened. The other thing I'd say about customer revenue, remember, we said it can take up to 6 months to raise funding. But what if you spend exactly the same 6 months and exactly the same amount of effort trying to get customers? If you're only trying to raise $200,000 or $300,000 or $400,000, you may find you can actually get that from customers anyway, which then becomes non-dilutive and then actually sets you up to be in a much better position to go and raise capital. Okay, so I didn't talk about a couple. Venture capital, we're just chatting about. So venture capital, the only difference really is that you're dealing with institutional investors. They typically are going to write larger checks. For us, preferably, our smallest check's $1 million. So you've got to be at a certain point where that makes sense. We will go less if we think it makes sense. And then debt we haven't talked about. So debt, a couple of types of debt. One is you just get a loan from the bank, or there's other credit institutions. To me, I'm not sure that works for the kind of businesses that are in the room today, because they're going to need some kind of collateral. That collateral normally means you putting money into a term deposit or equivalent that matches that. And I'm like, well, if you're going to do that, you may as well put the money into the business, because that sends a better signal to your investor and you don't have to pay the interest. So I'm not sure it makes sense. The other kind that's definitely worth considering is called venture debt. A little bit different. Normally the entry point is once you're at about $50,000 a month revenue. What they will do is loan you up to 3 months of your monthly revenue. So let's say you're doing 50 grand, you could loan 150,000, and then you pay it back by paying 5% of your revenue every month until the principal and interest is paid back, which is normally over a couple of years. They will say to you it's a cheaper form of funding, but it entirely depends on a stack of factors. Like if you do a 2-year deal and then your revenue grows really, really quickly and you pay it off fast, but you've got to pay off effectively interest over a couple of years, that's actually a very expensive form of capital. So you just need to think about that. But definitely, if you don't feel like you want investors and you don't need multiple stages of venture type funding, that's an interesting source. Okay, so with all of that, this is kind of where we needed to get to. And then I'll work out how long we keep going for or not. We can either take questions or I can keep talking about equity and valuations and things. So based on all of that, you've now got your business going. And most of you are kind of at this stage. You need your first $50,000. That might be to run your first marketing campaign. It might be to bring on your next hire. Based on everything we've talked about, how might you do that? What are the sources of funding that you might use to get $50,000? There's no chocolates for this.
Friends and family.
Yep, friends and family. That's about right. What was that one?
Grants.
Grants. Good number for. Yeah, bootstrapping. So do it yourself or your personal money, I guess. Yep, accelerator. Yep, you get into the top accelerators, you get that much money. Yep, great. Right, that's your answer, right? So if you're looking for your first 50,000, and for most of you I can see in the room, that's going to be your next kind of funding step, right? Like if you get that first product in market, get those first couple of customers, you're going to need a bit of money, I suspect. And so now we've got some thoughts as to what that might look like. Let's say now we're building and we've got some product market fit and we're needing to scale, and we actually want to open up over East, or we want to build a bit more of an executive team, so we need to raise $1 million. How might we do that? Where would we go for $1 million? Oh, we missed one on the 50,000. The best form of funding. Customer revenue. Okay. What about $1 million? Can you do that with customer revenue? Maybe, yeah. Yep. Yep. I was involved in a business years ago in Perth called Flat Tummy Tea. They did $500,000 of revenue in their first year, $3 million in their second year, $11 million in their third year. So you can get to this money. Invest in a company through Better Labs called Complete Home Filtration. In fact, Charlie introduced me to her, and they were doing circa 25 million by their third year of business. So you can get these numbers on customer revenue, but where else might you go? For $1 million. There's someone literally standing in the room that has said, I can give you $1 million. Venture capital, yep. Grants. There's probably some grants, yep. Yep. Yep, maybe top end of the angel syndicates. You'd have to be really stand out, but you might be able to get there. So yeah, so you're kind of starting to move into that institutional kind of funding, or you can build custom revenue. Okay, I'm going to pause. I have 3 topics that I typically cover from this point, but we've asked a lot of questions along the way. So one of those, or it's all combined in the same thing, is why, as a venture capital fund, we pass on deals. And as part of that, I'll talk about equity and valuations. So I can do that for some time, or we can finish all together, or I can just take questions. But you guys can decide, because I can stay till 2 o'clock if you want, or I can go. So I'm happy to play the last bit by ear, and I'm not offended by your answers.
Yeah, I'd be interested to know why you passed on.
Keep going. Okay.
Will there still be time for questions after?
Yeah. All right. Let me try and I'll try to do the 5 to 10 minute version. I'll go quick. Okay. So this has Venture capital now, this is Purpose Ventures. 4 things. One is what I say is a lack of founder commitment or equity. So we've sort of talked about this, which is when we back you as a founder, we want you to be doing one thing and one thing only and putting all your time and effort into it. It is really hard to build a business. And often we see situations where you'll say things like, I'm bootstrapping, I'm studying, or I've got this, but I have another company that I'm involved in. It doesn't take up too much time. I have that conversation all the time. And even I'll say, even if this other business takes 5 minutes, if I'm going to give you a lot of my money, I want that same 5 minutes into the thing that I'm giving you money for. So the idea of being all in, now that's not to say this is the way you have to do it. Let me clarify that, because I often think of Elon Musk. I'm like, he's involved in loads of businesses and people give him lots of money. This is just kind of our philosophy. I think the idea of being a multipreneur is like doing many things is kind of cool. I'm just saying if you want our money, we're only going to make 15 investments in our fund. I want to put into people that are just all in on that one thing. So that's one part. The other thing is equity. And what I mean is, have you as a founder got enough equity? And so there's lots of ways that you might not have enough equity. Because we're all about backing you as a founder and ultimately backing your dream and your vision, I actually want you to do really well out of the business that you're building. And when things get tough, I don't want you to go, oh, I've only got 5% of this business, I'm going to give up and just walk away. Like, we want it to be a big enough incentive for you to keep building. And so the way you might end up with not enough equity is that before we meet you, you've given up too much equity to other investors that come in. Remember I said at the start, not all money is good money. So someone might come along and go, I'm going to give you $500,000, but I want 50% of the business. Well, when I meet you, I'm not just backing you, I'm backing them, and they might not be the same kind of person that you are. So you could be a bit low that way. That same investor might also not have a lot of equity, but they might have lots of rights and control of the business. So there's a misnomer in startups that if you own 51% of the company, you can control the company. But that's not right, is it? It's like the control comes down to who has the rights. And I can say to you, I'm going to give you money and I only want 5% of the business, but I want to make all these decisions. Now I control the company. So it's not about equity, it's about what the shareholders agreement that Paul was talking about. Sometimes what happens is, I'm not sure if anyone's in this boat here, but you might spin your company out of an institute or a university. And when you do that, that organisation wants some equity for the IP that they think that they've developed, which we don't have a problem with. It's just that the going rate is often 40%. And we don't like that, because whilst they've helped you build the business to that point, really all the hard work and all the valuation increase is going to happen after that. So we want the founders and the executive team to hold the bulk of the equity. So, and the other version of that, which you can see there, dead equity, this is where you've started the company with maybe another co-founder or two, and you've had a falling out. This happens so much. And then that founder's left, but they still own 1/3 of the equity. And so I just encourage you, if you're having to deal with a founder issue, you need to get them out of the equity cap table, or if not, at least down to something that's just sub a couple of percent or something. Because for us, if we come along and there's a founder that you've had a falling out with that still owns 20 or 30% of the business, first of all, that's concerning because they will have some ability to be involved in shareholder decisions. But also, I just don't think it's equitable, because you're going to go and build this company, and let's say we sell it for $100 million, you're putting all your life and effort into it and they're not involved. I just don't think they should get a free hit. So we don't like that scenario. And the other thing that can happen is, the reason you don't have much is you've had to raise a few rounds and suddenly you've got 30 or 40 or 50 investors in your business. And then it's, again, too hard to manage those shareholders. Other thing, someone asked this question, I think that was your question before, which is, when a venture fund invest, how much equity do they get? Most founders start with the position of, I feel happy to give away 10% of my company. And if you apply to our fund, we do ask you, what do you think the valuation is? And most times people kind of set it up that they feel like we're only going to own 10%. But you can see from this data, we've talked about seed round, Series A, on average, it's in this sort of 20% mark. We like about 15% when we invest. So somewhere between 15 and 20 is the number. The reason for that, in our case and most venture funds, is 15% is a number that allows us to get the kind of rights in the company that we would like. If we were less than that, we couldn't ask for them. But if we're more than that, suddenly we're starting to own as much as you. And as I was saying before, we want you to own the bulk of the equity and to be incentivized to build the company. And so we need enough to get the rights. But if we don't continue participating as you grow, we're going to dilute. So it's also got to make some sense to us. This information's from Carter, by the way. You can just find it online. And then someone else was asking this. I'll just have a look at it. There's just some other tables you can get from Carter that talk about equity. So someone was asking me, I think you asked about with my co-founders, and I said we were a third, a third, a third. But this is like, what does the startup founding team ownership look like? You know, what's the kind of split? And it's not the way we did it. So that's kind of some data there. When you hire people, you might give them a little bit of equity, which comes from what's usually called an ESOP pool, which is an employee stock option pool. You know, this is what that kind of looks like. And this one, there's a whole bunch of people that might want to help your business called advisors. In Australia, there's a whole industry around it, and often I see people wanting 2 or 3% of your business. All I'd say about that is if you look at the data out of the US, you know, they're getting 0.1, 0.2. That's how much you should be thinking. And even if you're doing that, I would just encourage you to put them on a earn up plan. So you don't just go, here's your 1%. You say, I'll give you 1%, but I'm going to do it over 3 years, and you've got to do this every year, and you earn up that way, because often those advisors don't always offer the value that they're offering. Okay, second thing, loving the solution more than the problem. It's a shame Charlie's not here, because he says this all the time when I've seen him present it. And that is, you come in, and in fact, it's interesting, not that it mattered, but everyone that pitched this morning pretty much started your pitch with, look at what I built. Like really, what you should do is go, this is the problem that I'm solving. A few of you touched on that, like I think you were saying the previous version of health stuff doesn't work, maybe, you know, so because the reality is what you're building at the moment may not be the final product that your customers want. You just don't know at the moment. But if you're going, this is the problem I'm trying to solve, and this is how I think I'm solving it. So just don't get those things back to front. We see it too often. If someone comes in and just pitches the product they've built, we lose interest pretty quickly. I've even invested in companies where I've met the founder, I've heard about the problem they're solving, and I've never actually seen the product because I'm just so sold on what it is that they're trying to do. Third thing is a lot of the stuff we've talked high level today is just business hygiene. So remember I said, once you've got an investor interested, they're going to do due diligence. And normally what happens is you put together a data room of all the information they need, your business model, your constitution, your shareholders agreement, all these kind of things. And if you come to us and we get interested in your business, and then we go into your data room and it's a mess, or you're not quite ready and we have to wait, it just sends a bad signal that you're not organised. And you can get all this ready before you go to raise money. Again, that's not what today's session's about. And if you haven't got a session, I can send to Chloe my data room list, the things we ask, and then you can just see what it looks like of the kind of stuff that you need. But there's lots of things that happen here that are reasons we don't invest. And what happens for us as an investor, when I meet you, if you came to our office and got to pitch to the team, our first job, all we're trying to do is, can we fall in love with you and your idea? That's like literally the first pass. Are you talking about something we're excited about? Can we tell it's your life's work and your passion? Is the plan big enough to get us interested? That kind of stuff. Then we go into due diligence and we do the exact opposite. We're like, okay, now let's try and find a reason not to back that company. And this is all the stuff that we're looking at. And it's some of the things we've said today. So you might have the wrong kind of investor on your cap table. Well, we don't want to invest now. Your IP ownership might not be set up the right way, or it might be that you built a product, but it was a third-party product company that built it and they own all the IP, so you don't actually own the IP. So that could be a problem. You could have taken debt, and we don't like that kind of debt. So there's all these kind of things that are like what I just put in the bucket of business hygiene. And then the final one is unrealistic valuations. And so, we've kind of talked a little bit about that today. I've tried to give you some guides along the way. What's interesting to me, and I was the same, founders think a lot about what someone's saying your company is valued at, but it's kind of not really about that, in my view. If you need capital, I'm kind of saying, well, as an investor, I need about 15 to 20% of your business, which means if you need $1 million, let's just agree your company's worth 5 million and we get a deal done. And it's not to say you can't convince me that your business is worth 20 million, but by trying to do that, I probably won't invest in the business because I just can't get the dynamics of investment that I need to work. And really today, whether your company's worth 5 million, 6 million or 7 million, if I'm going to give you $1 million, does it really matter? Because what we're trying to do is build a company that's worth 500 million. And what we're negotiating at that point in time probably doesn't make sense. And so we do have some founders that come in and they'll think that their company's worth whatever and they're entirely fixed on it, and we'll go, that's great. We just can't invest in the business at that level. Now, when it comes to valuations, I think this is probably where I'll stop for now. We're not going to do a whole session of valuations. The only thing I'll say is it's often said that it's hard to value a startup, but I think there's some science to it as well, and this is roughly how we think about it. And so A is milestone progress. You've done some things that have created value in the company that we want to pay for. To get an idea of that, if you're interested, you look up something called the Berkus method, B-E-R-K-U-S. And what it does is it says, you can attribute value for things. Have you got an MVP in market? Have you got a great idea? Have you got some paying customers? Have you got any contract base? Every time you've done that, you've de-risked the business and added value. And so we can attribute value. And then what we say is you've obviously got a business model of where you think the company might go in a few years' time. I'll tell you right now, it's wrong. It's meant to be wrong. You're a startup. You don't know. But what it is your best assumptions of what you understand at the moment. And so we want to work out, can we back that plan that you've come up with? Do we think that's realistic? And we've got a whole stack of data of how fast you can grow versus the average of fast-growing companies and things to help you validate that. But if we agree that, then we can kind of get some of your future value and use traditional financial methods like discounted cash flow and bring that into today's terms. So somewhere between the progress you've made and the future, there's a number that kind of makes sense. But at the end of the day, it still comes down to this target equity position that you've got in mind and we've got in mind and how much money you need. The other thing that you can think about is comparators, what we call comparatives. So you can come to us and say, well, I've seen this company and they've raised this much money and we look a lot like them, so that's how we should be valued. The thing I'd just say about that is that we've probably got more data on that than you do anyway, so we would rather try and help you with that as opposed to you kind of just forcing that on us. But also, you just need to make sure that it's comparative. So you're a Perth company raising money in Western Australia in 2026. That's very different to a US company that raised money in 2023. It's like you can't go, well, there's a company like us in the US that raised, it's like, well, you have to go there to that capital source if you want to kind of get that comparative. And final thing, I'd say if you're talking to investors, this one, which maybe I should say at the start, is due diligence is always on. We're always, like if I meet you, literally when I heard you pitch, I'm not sure if Chloe set you up for this, I'm listening to who you are, I'm listening to how you pitch, I'm listening to the progress that you've made, because it's maybe in a few weeks or a few months or a year, you might want to come and talk to me. And I have this weird knack for, I will remember the pitch that you did at this point in time. That's not to freak you out. It's just to say, just always put your best foot forward. But I would just say also be authentic. The best thing you can do is you're all smart people in this room and you're building this company for a particular reason. You have your why. Just be authentic around that. This is why I'm doing it. This is what I want to try and do. Be honest. And then that goes a long way to doing your best form of due diligence. In the pack, just so you can see, our fund doesn't matter. We've got some money if you need it. We've talked about that. We're going really well. I can ask the questions. I would say do due diligence on your investor as well. It always feels like a bit of a one-way relationship, but it's not. Because remember our first point, not all good money is good money. And the only way you're going to know is to ask your investors questions. And so in that pack is a bunch of the kind of things. I would like you to ask us this. I think we've got good answers to this, but I can assure you some of the funding sources around maybe don't have the same kind of answers and you've got to work out alignment. Questions? We got there. There we go. Yeah.
Derek, just on exit plans. So some founders may have exit plans of their own and they want to sell the business in a couple of years to whatever. Some mentors may advocate that actually always is good for founders to have an exit plan. How do you feel about that?
Yeah, great question. So definitely some investors will say, what's your exit plan? We will not ask that question. And in fact, if you started talking about exit in my meeting, I probably wouldn't invest because I'm like, you're thinking about the wrong thing. And the reason I say that, I've been through a lot of exits and exits happen not because of a plan you have today of what's going to happen in a few years, because literally nobody knows. The exit happens for one reason, in my view, and one reason only, or two. And the main reason is you build excellent value for your customers. just build a great business and the exit will take care of itself. And the second factor is just random timing that is mostly out of your control. Like, you know, we got acquired by a company, and it happened because a French energy company reached out to us because they wanted to acquire us and put an offer on the table. We weren't ready to sell or thinking about it. And we then talked to some of our customers, and another one of our customers ended up buying us. It wasn't part of, I mean, at one point we wanted to, but it just happens like the random timing. So think about it in the sense of, you know, maybe we want to be acquired or something, you know, down the track, and maybe, you know, maybe we're thinking about a listing as that pathway, or a trade sale, or the kind of party. And definitely an idea of, hey, like for example, we invest in ed tech companies, a couple. I know there's a lot of aggregation happening in ed tech, same in aged care. So we've kind of got a thematic around industries because of what's happening, but there's no way a founder could tell me right now how their company is going to exit. So, yeah. Is that it? Wow. Oh.
What was the last investment you made?
We haven't announced it publicly yet, but it's a company called Enroller. The CTO is a lady from Perth and the CEO is in Queensland, and they have a view that in time, when you're buying a service like telephone or electricity or insurance, your AI agent will be dealing with the agent from that organisation. And so they're starting to build what is the AI, the agent-to-agent buying and selling infrastructure. And they've got a first way they're monetizing that just through lead generation conversion with some great stats, but that's it.
Do you have any advice on like your fund?
Yes, I have advice. Is that a question? I have advice, yes. Always.
Yeah, so basically like hardware-based deep tech, right?
Oh, yeah.
The trajectory that, say, Flowbat is working on is quite vastly different to, say, software startup types. My experience with it, at least, especially in hardware, in Australia, is that you need to have some sort of prototyping results. Basically, you need to validate your product in front of customers or potential customers for people to look into it more, right?
Yep.
And then the conundrum becomes, okay, you need some money to build a prototype.
Yep. I got it.
But then, like, kind of, okay, is it the chicken or the egg, right?
Yep. So got it. So historically, in Australia, particularly, venture capital has just loved software as a service. And just because you can grow so fast and get revenue and get exits on multiples. And so the saying is always hardware is hard. There's been very few venture funds that have put money into hardware for the reasons that you've talked about. I would say that's changing a lot and very quickly. And there are more deep tech investors in Australia than there has been. And the reason I'm saying it's changing is if you can think of a way of framing your hardware business as physical AI, that's a really exciting space for investors at the moment, and it's forcing them to move out of software as a service, which is basically being destroyed by AI and all the big AI engines. And if you look globally, the valuations have come down massively on SaaS, but AI itself is mostly going to be run by the already big global players. But where investors can get excited is the use of that AI, and that's in various applications, but one of them is physical AI. So how does AI actually interact with the real world, which I think, you know, and energy particularly is a huge part of AI, right? So I think if you could frame and think about your business in that way, your point's still valid. You've got to have some kind of prototyping, but you might think about some of the early sources of the booster grants and stuff that, you know, could help you get there. I think you could also look at, you know, if you did get the likes of some of the Woodsides, BHPs interested in technology, they might help you fund a bit of a prototype. But then there are specific hardware investors in Australia. So you can think about Main Sequence. They actually backed a venture company a couple of years back. Melt Ventures is one of the WA VC government-backed funds. I'm not sure how much money they've got left, but they will back hardware. Another one called Salus Ventures, SALUS. And we've backed hardware companies. So Andromeda is a robotics business. On the House, I told you about their hardware. So, you know, we have some interest, but it's for us to invest in hardware and pre-revenue, it's just about understanding the pathway to when you could get revenue and believing that we want to fund you all that way. So if you're a hardware or pre-revenue business and we can't get you to revenue, we're probably not the right investor. But if $1 million, for example, unlocks revenue and you can prove that to us, then we're quite happy to get involved. Yep. There.
sector moving, what would be your reservations in putting money in AI back?
Yeah.
Heavy dependent tech stuff.
Yeah, that's funny you say that because we've got 5 companies in our portfolio raising money at the moment. And for some of them, they're a bit light on their AI strategy. So they go to venture funds and those funds say, oh, if you don't have an AI strategy, we don't want to invest. We've got the other companies that are AI and they go to the same venture funds and they go, because you're AI, we don't want to invest. So I'm like, what are you meant to do? And they're saying, because no one really knows. And so that just comes down to the fund. My thesis is we want to back AI companies because, I've, like Charlie can tell you these stories. I've lived in the creation of the personal computer, then the internet, then .com and all the things. And it's like, it's just the next wave of technology. And you've got to be in it, I think. Like, you've got to be part of it. And this is the most exciting of all of those. If we invest in AI though, and this is something to think about how you position to investors, we're looking for 3 or 4 things because you're not going to be your own LLM and there's no point just being an application layer to models that are built. So we're looking for either a proprietary data source that you've got that you can point to. That means the larger LLMs can't access that. We're looking for like niche industry workflows. So, I think yours business is quite interesting. The idea of that initial IT architecture, that's probably quite niche. So if you've got some way of having unique IP around that, that'd be interesting. Third layer is what I'd call the network effect, as in you just have some unique way to access a market that the AI engines can't. So, for example, we've got an AI business in schools. They have a great relationship in the education sector. That's a network effect because once one school buys, the next one buys, they all start buying from you. And then the 4th thing I'd say is there a layer of governance or compliance. So, for example, we're in a business called PlanCare. You can't just go and create PlanCare's business because you have to get a license and you have to be audited. Doesn't matter how much AI you've got to go through that compliance. So I think for us, if a company can point to one or more of those 4 things, then we're happy to take interest in an AI business. Yep.
What degree of influence do investors like yourself sort of expect to have in a company wants to invest? Is there any sort of risks or sacrifices that founders kind of have in mind?
Yeah. Great question. It normally comes up much earlier than the last few minutes. But again, first point, not all money is good money. So different investors will want different things and you need to figure out what they're asking for and have you got alignment with that and are you okay with that? In our case, and probably every venture fund in Australia's case, we use a very similar set of documents and rights. So some of those things, like if we're going to give you $1 million, we've got some things we want to make decisions with you. And so the couple of majors that matter, there's a list of business decisions and it basically says if you want to do any of those things, both you and your board and us need to agree to that. And normally they relate to things that are either spending money or changing the equity of the business. So if you're going to issue more shares, we need to approve that because we want to make sure we're happy with the incoming investors. If you're going to have capital expenditure above a certain amount, let's say $100,000, you need our approval. Because otherwise, if I don't do that, I can give you $1 million, you can go and buy a new Ferrari and I can't do anything about it. So there's just things like that. We also say that we are allowed to appoint a director in the company as long as we own a certain level of equity, so we can come and sit on the board with you. And that's normally setting up so that as your company grows and that decision making starts getting shared, we're just part of that decision making. The thing I would say, and when you first look at it, it's like far out. There's a lot. It can look like a lot of stuff. And alignment's so important. Like I can hand on my heart say, and you can talk to any company I've ever invested in to ask if this is the way it works, is if we're going to give you that amount of money, we just believe we've seen a lot of the errors before and we're just trying to help. And these things kind of force the issue of that help really. And it's helping you kind of figure out, the steps that we think you need to make in those first couple of years. In reality, if you're doing well, you'll raise more money and that decision making will get broader to a board as you grow. And so we're just trying to get you from here to that kind of point. But if you talk to any of our companies, hopefully, I'm pretty sure they'd say, we normally, if we're involved in that, we'll take like even just a few hours to help make that decision. We're usually meeting with you every month anyway. So a lot of that stuff we kind of are working with you on and we know it's coming and stuff like that. So, but yeah, I think, Paul made the point, there's, the moment you sign that agreement, like if I'm being completely honest, I've got one company at the moment that is underperforming significantly. And now I'm having, I can tell you I don't want to, but I'm having to rely on those things to actually try and get some control back in the company because they've gone like fully rogue. So, you've got to think about that as well. That's not a good scenario for anyone, but they can play out like that as well. So, but alignment is the key. Yep. All right, I think we're probably done now. Great.
Thank you.
Thanks.